If you're studying chart patterns, I prepared for you the list of 7 price action patterns you should never miss. In this video, I will share with you powerful price action patterns for trading Forex or any other financial market. These patterns can form on any time frame and they work perfectly for scalping, day trading, and swing trading. We will study a lot of real market examples. I will explain to you the psychology and the meaning of each pattern and explain how to trade them. And at the end of this video, I will reveal the most powerful pattern. Please don't forget to like this video, subscribe to my YouTube channel, and let's start. The first pattern that we will discuss is double top. Double top is usually formed at the end of a strong bullish movement. You can see that here in dollar CAD on an hourly time frame we got a strong bullish impulse. Then the market reached a very important horizontal structure resistance. You can see that here we have a significant resistance level that was respected multiple times by the market, and from where we saw strong bearish reactions. After the test of that resistance, the market retraced, and here we saw a local bearish movement and the price set a higher low. Then the price bounced again, and here we set the equal high. Then the market dropped and we saw a strong bearish movement. Here we see a perfect example of a double top formation, and the pattern is based on 3 important elements. Traders, learn price action patterns with my premium course. Learn how to identify classic price action patterns and get a profitable price action trading strategy. For more info, check the link in the description below. The first element is the first top. The second element is the so-called horizontal neckline. It is the minor support where the price sets higher low and from where we see a bullish movement to the second top. And of course, the third important element of the pattern is the second top. Why this pattern is so important? Because this pattern signifies the exhaustion of buyers. The formation of this pattern here signifies that buyers went exhausted once they faced the strong horizontal resistance. And the fact that the price started to form the double top simply means that buying momentum became weaker. And once you spotted this pattern, you should always remember that the formation of the pattern by itself is not the signal for you. When you spotted this pattern, the signal that you should look for is the breakout of the neckline of the pattern. The neckline of the pattern is the resort for the buyers to buy from. That is the area where buyers are placing their buying orders. And the violation of that, the candle close below that, is our signal. It is the strong bearish signal, and after that signal we can short the market on a retest of a broken neckline of the pattern with the stop loss lying above the highs of the pattern. Strictly, we can anticipate a bearish movement to the closest strong support, and our closest strong support is right here. So your trade would look like this. That is how we trade the double top pattern. A bullish variation of a double top pattern is called double bottom. Double bottom pattern usually forms at the end of a strong bearish movement. You can see that here in Euro New Zealand pair in a 4-hour time frame we got a very strong bearish impulse. You can see that we got a massive sell-off, and then important event happened. Then the market reached important horizontal structure support. You can see that right here we have a very important historic structure level. Once that level was reached, you can see that the momentum started to slow down, and you can see that the price retraced and we set a lower high here. Then the market dropped and we set the equal low, and then the market returned back to the level of the last lower high. Again, the pattern signifies that sellers are weakening, that sellers most likely start taking profit, and that buyers started to buy, and for that reason the market stopped falling and started to consolidate. The main element of the double bottom formation is of course its horizontal neckline. This minor horizontal resistance is the area from where sellers are selling. You can see that analyzing the price action, we see multiple local bearish reactions. to that minor resistance. And once you spotted the double bottom formation, you should remember that the pattern by itself is just the warning sign for you. The pattern by itself is not the signal for you to buy. Your signal to buy will be the breakout of the neckline of the pattern. If the pattern is spotted on a 4-hour time frame, for breakout of a neckline, we will need a 4-hour candle close above that. Then the broken neckline will turn into a support, into the area from where you can buy the market. Buying the market on a retest of a broken neckline, you always set your stop loss strictly below the lows of the pattern. It will be the safe stop loss for the trade. And the target will be the closest strong resistance. We can spot a strong resistance right here, so that will be the target for the trade. And you can see that here the price formed the pattern, but the price is still staying below the neckline. Remember that the market may easily drop lower. The trend is bearish here and the market may continue falling. If the price sets a new low right here, the pattern will become invalid and we will not trade it. The third powerful chart pattern is a descending triangle formation. A descending triangle usually forms at the end of a strong bullish impulse or after a completion of a bearish impulse. And the pattern is always based on two important elements. The first element is the horizontal neckline, the horizontal support where the price sets multiple equal lows. And the second element is the falling trend line. Falling trend line where the price strictly sets lower highs and respects that trend line. These two elements will compose the descending triangle formation. We see a perfect example of a descending triangle formation on pound New Zealand pair on a daily time frame. And this pattern will be also called a bearish accumulation pattern. We call that pattern a bearish accumulation pattern simply because the bullish legs, the bullish impulses, the bullish reactions from the neckline of the pattern become weaker here. You can see that the neckline of the triangle here is a strong horizontal support. And after each test of that, the reactions of the price to that become weaker. It signifies that the buying volumes decline and the selling volumes accumulate. And our trigger, our signal here is always the breakout of the neckline of the pattern. Once the price violates that, once the price closes below that, it is a very strong bearish signal for us that signifies a highly probable bearish continuation. Once you spotted the breakout of the neckline of the pattern, you should remember that the broken neckline and the trend line will compose the contracting supply zone, the area from where you can look for selling the market. And the next goal for the sellers then will be the next strong support, and our next strong support in that example is that horizontal structure. It will be the next goal for the sellers. A bullish variation of a triangle pattern is called the ascending triangle. The ascending triangle formation usually forms at the end of a strong bearish impulse or after a completion of a strong bullish wave. Here in gold on a 4-hour time frame, we can see that the market was very bullish. And here we got a very strong bullish wave. And then after that, the market started to contract, the market started to slow down, and the price started to set equal highs and higher lows. Here we have a perfect example of the ascending triangle formation. And this pattern we will also call the bullish accumulation pattern. Why? Because here, if we analyze how the market reacts to that red resistance, we can spot that each and every reaction of the price to that becomes weaker and weaker. You can see that here we have 3 bearish movements from that resistance to the trend line, and each consequent bearish movement is weaker than the previous. It signifies the weakness of the sellers. Our trigger here, our main signal here will be the breakout of the neckline of the pattern. Here, the formation of the pattern signalizes that the market is preparing for a breakout attempt of that horizontal resistance. And our trigger, our bullish signal here will be the breakout of the neckline of the pattern. Once the 4-hour candle closes above that, it will be a very strong bullish signal for us, and then a bullish continuation will be expected. Pattern number 5, cup and handle pattern. Cup and handle pattern usually forms at the end of a strong bearish impulse. You can see that here on New Zealand CAD on an hourly time frame we formed a strong bearish impulse. And with this impulse, the price reached an important horizontal support. You can see that once that support was tested, the price bounced. And here we have a perfect example of a cup and handle formation. And the only difference between cup and handle formation and the double bottom is that with the cup and handle formation, the price simply forms a higher low, not the equal low, but the higher low. That is the only difference between the double bottom and the cup and handle formation. The pattern also has the horizontal neckline, and the breakout of the neckline of the pattern is a very strong bullish signal for us. What is also very important to note is that cup and handle formation is more accurate than a double bottom. The fact that the price set a higher low signifies that sellers are so weak that they did not even manage to retest that horizontal structure, that they did not even manage to set the equal low. After the breakout of the neckline, the broken neckline turns into a very strong support from where we are buying the market. From the broken neckline, we open a long position. Buying the market, our target will be the closest strong resistance. In this example, our closest resistance is right here. And the stop loss for the trade will lie below the lows of the pattern. It will give us a safe stop loss for the trade. A bearish version of a cup and handle pattern is called the inverted cup and handle formation. Inverted cup and handle formation usually forms at the end of a strong bullish impulse. Here in pound CAD on a daily time frame, we can spot a very perfect example of a cup and handle formation. You can see that after the price tested that significant horizontal structure resistance, the market stopped growing. You can see that even though the market was rallying and even though the bullish momentum was very strong, once that horizontal resistance was reached, the market stopped growing and the cup and handle formation was formed. The only difference between the cup and handle formation, the inverted one, and the double top pattern is that here the price sets the lower high. Instead of setting the equal high, the price sets the lower high. The pattern also has the neckline, the resort for the buyers to buy from, the minor support that the price starts respecting after the formation of a higher low, and the trigger again is the breakout of the neckline of the pattern. Once we spot the violation of the neckline of the pattern, the candle close below that, for us it is a strong bearish signal. For us it is the signal that the market will start a strong bearish movement soon, and it is the trigger for us to open a short position on a retest of a broken neckline. Selling the market on a retest of a broken neckline, our stop loss strictly lies above the highs of the pattern, and our target will be the closest strong support. And in our example, our closest strong support is right here, that historical structure. The last and the most powerful pattern is the range. Horizontal range can form everywhere. It can form after a strong bearish impulse. It can form after a strong bullish impulse. It can form in the middle of a strong bullish or bearish rally. Here in pound Swiss pair, I see a perfect example of a horizontal range. You can see that here the price respects the strong horizontal resistance and the price respects the strong horizontal support. What you should realize about the range is that the range is the continuation of a double top or a double bottom formation. You can see that here the price formed a double top pattern, but then instead of violating the neckline of the pattern, instead of violating that and going lower, the price respected the neckline and the price started to grow to the resistance of the range. That is why I said that the formation of a double top or a double bottom is a very poor signal, simply because the double top or double bottom can easily turn into the range, and the range signifies that the market found the so-called fair value, that supply met demand, that the market found equilibrium. And once you see the range, you should note that the price may stuck within the boundaries of the range for a very long period of time, and we never know how long the market will stay within the boundaries of the range. For that reason, the resistance of the range and the support of the range will provide the trading opportunities for you. The resistance of the range will be the area from where you can look for shorting the market with the stop loss lying above the highs of the range, and the support of the range will be the area from where you can look for buying the market with the stop loss lying below the support of the range. Also remember that while the market is trading within the range, the trading volumes are accumulating and the market participants are waiting for some trigger. They are most likely waiting for some important fundamentals to decide where to push the market next. For that reason, the breakout of one of the boundaries of the range will be a very important signal. Bullish breakout of the resistance of the range and the candle close above that will be a very strong bullish signal that will push the prices to the next strong historic resistance, while a bearish breakout of the support of the range will give you a strong bearish signal that will push the prices lower. The range provides a lot of trading opportunities. As I said, you can trade the market within the range or after the breakout of the boundaries of the range, and for that reason it is so important to learn to recognize that. Of course, there are more patterns to study, but these 7 are essential. Your ability to recognize them is essential for profitable price action trading. Learn to spot these patterns, and good luck in your trading. Let me know, traders, in the comment section what patterns do you want to learn in the next videos. Also, traders, learn price action trading with my course. For more info, check the link in the description below. Also, traders, please watch my other videos.